Hey guys, when I first heard about that, I was so excited. Imagine that, ETF for SPACs. That is huge. Imagine that all these commissions that you have to pay for each and single one SPAC that you are paying, you don't have to pay these commissions. Or imagine this, SPAC ETF full of pre-merger SPACs. I mean, you don't have to keep track all of them. That sounds so amazing. But little did I know. This video contains unique information. It takes a lot of time. I only ask one thing. If you find value in this video, please subscribe. This way we can create a community that shares information about money. And also it gives me a feedback that I should keep posting. So please do that. Also, just a quick update on new ticker Hyliion. It looks like we have a new support on $40 level. I mean, obviously not a great day for Hyliion, but I expect better results on Monday. I learn something new every day, and I might probably stick to the plan B, and I will take this stock long term. I believe that Hypertech technology will take this stock to appropriate levels. Okay, let's get straight to the SPAC ETF. On October 1st, Business Wire announced that the company Defiance launches a new SPAC ETF. So let's look at their website. You can see that they have some nice design and pictures. If you've ever seen a Berkshire Hathaway website, you know that the results are not from nice design and pictures. So then we have some motivational paragraphs. I like it so far. Let's read what it is. The Indxx SPAC and the NextGen IPO index is passive rule-based index that tracks the performance of common stock of newly listed special purpose acquisition companies, ex-warrants and initial public offerings IPOs derived from acquisition companies over the preceding 36 months. Okay, they're going to include companies that are 36 months after the IPO. Well, I don't even have to go through my data because there's an actual study for this. This is the study from Goldman Sachs. The average SPAC underperformed the S&P 500 and Russell 2000 indexes 3, 6, and 12 months after their merger completion. According to Goldman Sachs Group's analyst who analyzed 56 SPAC deals since January 2018. I mean, this is old study, but basically Goldman Sachs does not approve their strategy. I mean, this is not something what they said, but this is what I assume from this. I remember when I was going through my data about SPACs, I made the deal with myself. I said I'm not going to trade companies after the IPO, only until the IPO and then get out. So be very careful about these rules that they're setting up for this ETF. I mean, I'm really curious if they can change those rules, because if yes, it can have big impact on the results. And SPAC companies have cycles. They live in cycles and their performance change based on the cycle of the SPAC. So, let's move on. My first thought was why this ETF is not holding most of the SPACs, and instead they hold only 35 of them, which is about 20%. But then I was like, okay, let's give these guys a shot. Maybe they have something. Maybe they have some strategy or method, how they choose which SPAC companies are going to be there and which will not. They're going to surprise me. Let's go to their rules. An 80% weighted is applied to IPO companies derived from SPACs, and 20% is allocated to common stocks of newly listed special purpose acquisition companies. This is very important. I saw some other channels and some magazines, they have this information wrong. From what I take from this is it means that 80% of companies which they will own will be IPO companies already after the merger, and 20% of SPACs which are not, they don't specify whether they are before or after the merger. Okay, let's look at their distribution. You can see the stocks right here, right? So 35, 36 companies, and if you look at these three first stocks, you see something weird. Okay, these three first stocks have 40% of the total value of this ETF. 3 stocks have 40% of the value of the whole ETF. Is this a good distribution? Does that sound like ETF? I mean, make your own opinion. Let's look at their team, and I'm going to be very strict right now about them because there are many ETFs and you can choose to buy any of them. So you want to compare them to the best, right? And one of the hottest ETF right now is ARK Invest. It is the early investor in Tesla. So there is a difference. ARK Invest is a actively managed portfolio, and the ETF SPAK is a rule-based, which is a big difference. Let's compare. Okay, we can see ARK Investment. They have 36 employees and the CEO is Cathie Wood. Okay, let's read her LinkedIn profile. Cathie Wood and her experience. She has been an 18 years portfolio manager, then equity research analyst, and then chief economist. Then she was 12 years chief investment officer. And then for 6 years, she's a founder and CEO of ARK Investment. Okay, there's really solid CV. Let's look at SPAK. So you can go on their website and you can find out that the CEO is Matthew Bilski. As you can see right here, it's written that he is responsible for driving the overall firm strategy. So he's the CEO. Let's check this guy. So he was analyst for 1 year, then he have 3 years break, I guess. Then he's associate, vice president, co-founder, and chief executive officer. That sounds like a lot of management and a lot of executive, right? So my question is, where is the experience? I just don't see it. I mean, this guy doesn't even have a photo here. I wouldn't brag about the photo, but look at that. They have their link in their main menu to LinkedIn, so they expect people to come here. I mean, I don't want to be mean. He might be brilliant, but he's managing $2.6 million. I mean, guys, this is not a game. It is your money. Another breakdown is that this ETF is managed quarterly. That means that if you want to take advantage of some huge merger that just happened and there are some profits waiting to be locked down, you cannot take them. Imagine like Nikola stock, you know, this stock went from $10 to 90 and some smart investors locked their profits, you know, and this is what they did. And these people will not do that for you. It's managed quarterly. They can do nothing. Guys, I love SPACs. I invest most of my money into the SPACs, but don't let anyone run these highly speculative stocks on a quarterly basis. The truth is that the rule-based ETFs, you know, they're clueless the same way as any other institution on the stock market. If you have read the bestseller book, Common Sense of Investing, you know that ETFs are tough. I don't like to judge another investments. I guess I'm just disappointed. I was really excited when I heard about it. I was like, wow, new ETF, that's cool. I mean, I don't have to pay the fees to buy the each and single one SPACs, and they will hold like 100 pre-merger companies. But no, this ETF might actually charge you fees for buying each single stock. They didn't earn my trust. I haven't heard anything revolutionary about their approach. And you know, the split 80-20, I just think it's bad, in my opinion. I like the idea of diversifying SPACs. It is something what I have been doing lately just to get more consistent results. But if you cannot exit SPAC company in the right time, that is just a huge turnoff for me. Long story short, I am not buying this ETF, and you should do your own research because this is not a financial advice. More videos are coming. See you soon and bye.